Hey everybody, this is Jim at SP500chart.com. It's about 6:30 on April 7th, 2013. We're going to take a look at the weekly review for the week ending April 5th, 2013, and we're also going to take a look at what happened on the 5th. Before we do that, I just need to remind you that the website and the video are for educational purposes only. Nothing stated at the site or in this video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research. And you should be making investment decisions that are suitable for your personal financial situation. And by the way, seek out good, solid advice from a licensed financial professional. But sadly, I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look. Okay guys, we looked at a down day on Friday the 5th, a pitiful jobs report, and folks, I'm going to politicize here, but it's just a simple fact. When you don't have people who know how the business sector works, they don't know how to create jobs. I think it's just that simple. This is the worst recovery since World War II. We have been going on now for 4.5 years from when the bottom fell out, and let me tell you something that is a fact, and it doesn't matter which side of the political fence you side with, it is still a fact. If we had the same number of people in the job force in March of 2013 that we had in January of 2009. In other words, if the number of people who were seeking employment and who were, quote, employable, active in the job market, were in the job market in March of 2013, we would be looking at, instead of a 7.6% employment rate, we would be looking at 11%. And that's just a fact. It's math. You look at the size of the job pool, and then you look at the number of people who are working. The only reason we're at 7.6% is because we now have the smallest labor participation rate since 1979. That does not bode well for the economy. But I want to remind you, the economy is not the same thing as the stock market. We've all seen it before. When things look terrible, the market goes up. When things start to look good, the market goes down. I've made mention of the fact that I believe one of the reasons that Democratic administrations tend to preside over periods of time when the market rises is because the market is forward-looking. So I'll leave that to your own devices. When Republicans are in the presidency, things tend to be better for business, but that creates a top. When Democrats are in, that creates a bottom. And we know that when we're at a bottom, there's no way to go but up. And when we're at a top, there's no way to go but down. So Republicans have a tendency to create tops because things are good. And Democrats have a tendency to create bottoms, well, because they create panic and scare the bejesus out of people. So, I'm through with my political comment. Let's, instead of looking at a weekly review, let's look at this 30-minute chart. What happened on Friday is another little small piece of the potential puzzle that I mentioned last week before Friday, and that is we may be looking, not saying it yet, but we may be looking at the formation of a top here. And the reason I say we might be is we broke this blue sort of semi-wedge shaped channel on Wednesday, Could not get back into the channel on Thursday, and on Friday came back down pretty hard, right to where I had drawn a potential, and I boldface italicized that and put it in blinking neon. A potential little Head and Shoulders up here. And what's interesting is, and again, I'm going to talk out of turn here, this is potential. This is just put it in the back of your mind. Don't trade on it yet, but put it in the back of your mind. We may be looking at a little Head and Shoulders top here, and if we back out to an hourly chart, we could even be looking at an even larger Head and Shoulders pattern with the neckline at around $14.95. That's just a guess right now. I'm not saying that's going to happen. I'm just saying it's possible, because that's kind of the way things are looking right now. We've got this red line up here around 1600 where we would expect some very strong resistance. We have not tagged that line, and it's possible we won't tag it. There's no guarantee that we do that. But getting up to 1570, hitting an all-time high in the S&P, you tell me, if you were looking at this chart right here, and you are a long-term investor, and you maybe even were invested back here in 2000, maybe you were invested in 2007, and now you're looking at where the market hit, you tell me what that looks like prudence. The prudent move would be, if you ask me, the prudent move would be sell, sell, sell up here. If this line breaks and you get a signal that the market wants to go higher, even much higher, you can still get in. But if you don't sell here and things start to do what they've done before, then you may face the same fate. So that's all I'm saying. We are not at a top yet. You can look back here and see Head and Shoulders top. You look back here, Head and Shoulders top with a double head. You look here, and we just really see that initial move up. So there could be more play that goes back and forth as we look at the market going ahead. We're going to take a look at a couple other charts today as well, but let's now do the weekly review part. And the weekly review was simply this, that we came into the week looking at this line right here as offering support, and as the market would have it, on Wednesday that support broke. Once that broke, we then knew to look for this line becoming resistance, and later that day, well, actually the next day, the S&P rallied back up to that line, looked like it wanted to do it again, but then sold off sharply on the bad employment news. So what it looks like to me is this line has been shown to now have turned the tide, and where it was support, it is now resistance. Additionally, it looks like we may be forming another little downward channel here. And with this bounce on this potential neckline at about 1540, go back and listen to last week's videos. We talked about 1540 as a good level to expect a bounce, and so far we've gotten it. There's no guarantee that that's going to hold. Matter of fact, if our Head and Shoulders top theory pans out, it won't hold. Okay, so what are we looking at coming into the week? Well, to begin with, for really the last 1, 2, 3, 4 days of the week, we really stayed pretty much in between these two orange lines. So any move up at this point, and it goes without saying, it's kind of obvious, but I would take a break of this orange line as a signal that the market is ready to say, okay, we're done with this downward little draft here, and now it's time for us to rally back a bit. Now, the question would be, if the market does rally back, is it going to rally and set a new high, or is it going to make a right shoulder and then come back down, excuse me, come back down and test 1540 again? Only time will tell. I want to remind you, the value of technical analysis isn't always in being able to make a bold and accurate prediction on what the market holds for the future. But the value of technical analysis is often simply knowing that this is where the boundaries are set. This is where we expect things to either bounce or break. If it bounces, great, we're going up. If it breaks, then we're going down. And so I guess it's a little frustrating to me, because I know probably a lot of you want to try to find some method that's going to say, tell me the S&P is going to go to 1623 and then it's going to reverse, and then I notice short at 1623 and it's a sure thing. Nobody can do that. Now, somebody will say that, and if that becomes true, they'll get rich and famous for it, like Bob Prechter did before the 87 crash. So, but since then, how good has Prechter been? That's subject for discussion. I don't have time for it. But I would say, what I'm trying to say is, of the number of people who follow the markets and make calls, somebody will get it. And that person will say, look, I called this. And that may be the last thing in their entire life that they get right, because it was sheer luck that they got it to start with. So, all of that to say, while I would like to be able to look at this and say, this is where we're going, I can't. I can tell you that it appears to me that we are forming, or are in the process of forming, a top. You know something? It's 6:47. I'm going to go see what the futures are doing. I'll tell you. I'll be right back. Hold on. Okay, the early Sunday evening futures are of no benefit. It's flat. So, I was just curious. So anyway, coming into this week, I would be looking for this move down here to 1540 to potentially create a breakout over this orange line. Would not surprise me one bit if we then come rallying back. The question that really becomes, do we rally to form a right shoulder and then come back down and take out this line? Because I'll remind you, we are very near our yellow line, which I'm going to have to move. We are really bounced pretty much on that line too, or very close to it. So if this does form a head and shoulders, then we would be looking not only at a little top to form here, but we would also be looking at this entire move from the middle of November until present being at risk of reversing and turning back down in potentially a more substantial downdraft than just the little dips that we've been seeing in late December and late February. So, again, looking at this 10-minute chart, I would look at this top line as your signal that the S&P is ready to rally. I don't think it's going to rally big. I think, 15, 20-point rally, back test to this line maybe, and then see if it comes back down. And if it comes back down, then we may be seeing the completion of what now looks to be a potential little head and shoulders pattern. Now, I want to also remind you, if we go to I think we need to go to a daily chart here. I want to look at the last two tops. The last one was formed in late winter and early spring of 2012. And what I want to show you is we made a head and shoulders right here, and the top of that head and shoulders was a triple top. Okay? So we made a left shoulder, rallied hard, made a triple top, came down hard, rallied back, and then we had a significant sell-off. if we look at the top that formed later in 2012. We rallied up hard, made a triple top, that broke down. We made something of a truncated right shoulder, but then that broke down, and this Head and Shoulders, which actually this circle is not here. Let me move this to where it highlights the pattern I'm talking about. There we go, right there. This Head and Shoulders right here had a triple top also for the head. If we look at what we've been seeing here lately, maybe it's better on an hourly chart. Here was a rally, and now are we making essentially another triple top? Because really, if you think about it, a Head and Shoulders pattern is sort of a triple top. It just has that middle peak in the middle. So this may be what we're seeing here. So I would just say advise caution going forward. We'll be following it as it unfolds and as it develops further. And I'll remind you again, we can go all kinds of things, do all kinds of things over the next couple of weeks. And if we don't break this neckline, then it's not a topping pattern. But if this neckline breaks after we form something of a pullback rally, then that would look awfully much like a Head and Shoulders up here. And if that does break, then we will, by necessity, we will have broken this rising yellow line, which means more than likely the S&P is ready to come back down to some more significant levels of support. I think the initial level would be where I've drawn this line right here at about 14.95. And if we were to bounce there, then could this be an even larger Head and Shoulders pattern that takes about 1, 2, 3, 4, 5 months or so to create? If that is the case, then we could be looking at a potentially more significant top than what we've been seeing over the past couple of years, because we've got some levels of support that you can see we would be coming down to test some pretty important levels. This blue line, for example, if this is a Head and Shoulders right here, and we do have a neckline at about 14.95, then we're going to take out this blue line. And this blue line starts way back in March of 2009, is drawn across the bottom of the low of October 3rd, 2011. It also lines up with our low in November of 2012. And if we take that out, then I would think, you know, we're potentially coming down for some more serious selling. And just to remind you, in the long term, these red arrows, what are these? Well, those are the sell in May and go away arrows. If you had done that in 2010, you would have done well. Not because it rhymes, but because that was a top. If you'd gotten back in before fall, you would have done really well. And if you'd gotten out in May of 2011, you would have done really well, especially if you were ready to get back in the fall of 2011. If you'd gotten out in May of 2012, well, you didn't get quite as big a dip there. And then here we coming up on May. Here it is. We're starting the second week in April. And I'm just wondering, even though I don't believe things are true because they rhyme, could it happen again? Well, all we can do is wait and see. And by the way, I just want to remind you, we did have two inverted Head and Shoulders patterns. This one right here, there's an inverted Head and Shoulders pattern. Then we had a very small one right here. Both of those made their targets when we got up to 1565. So we don't have any reason right now to necessarily expect the markets to rally, other than we are now down close to this trend line, and we may get a bounce there because of that, but due to the nature of what we've seen over the past 4 weeks, we're seeing some trends break. It's starting to look a little iffy, so I would watch this line like a hawk. Okay, quickly, let's take a couple looks at some other charts. Here's our NASDAQ chart, and here's our November low, and here are two additional lows that form this fairly, it lines up fairly well, but you can see here we are clearly now below this line. The NASDAQ rallied a bit as far as where the open was on Friday, but you can see that it looks like, I had to move that line, that we could be hitting potentially some gap resistance right there. And you can see where we've been looking. The NASDAQ is just a different looking chart, but you can see that long-term line right here has broken, and there's no way to draw it. There's no alternate way to draw that line to make it a pretty picture. The NASDAQ is looking kind of ugly. And guys, same thing with the Russell. It's broken. It's a broken channel here. No matter where you try to draw this line, you cannot make a pretty picture. Now, could the Russell come back and make an all-time high? It sure could. He could come back and rally to back test this broken line right here. And if it does, that would be a good spot, I think, to take profits if you have them in the small caps. Here's where it gets real interesting. You're looking at this and you're saying, well, wait a minute. I see a Head and Shoulders top up here that's already broken down. This almost looks like, Jim, this almost looks like what you say the S&P chart might look like in a month, or in 2 or 3 weeks. And you would be correct, because this already made a Head and Shoulders top, and it's bouncing down here, and it's looking like this now should be resistance. And if this, by the way, this is the Dow Jones Transportation Average. If we rally up to here, then come back down and break, then this is a pretty badly busted chart too. Again, you cannot draw this line, this channel line, in any way that paints a pretty picture. But I will remind you that this line right here is technically significant, because that is the previous all-time high in the Dow Jones Transportation Average. If this average does end up making a Head and Shoulders, and this line does break, then the Dow Jones Transport average would come down below this all-time high line, and frankly, if it did, I would probably not look for a solid support until the 52.30, 52.50, something around there. So this is not a particularly pretty picture here either. Now let's look at the Dow Industrials. And here we're looking at the Dow Jones 30, the Dow Industrials. And again, this is probably the strongest looking chart we have to look at. But I would watch this red line right here. By the way, that yellow line that we're looking at in the S&P, you can't even draw that line with the Dow. So this is really kind of interesting what it looks like we may be looking at. So I would look to this red line right here as the first line that the Dow Jones Industrials is starting to crack. So guys, there's a number of reasons to be on the lookout and to be careful at these levels. And if you are concerned about things, I don't think there would be anything wrong with either selling or lightening up as we're in this all-time high territory. Because if the S&P does break out over that top red line, this line right here, If it does break out over that line, signifying that this market is ready to just leave this range of the past 13 years and head on up for where no man has ventured to go before, well, you'll have a chance to get back in. But if it turns tail here, and if we are making a top, then prudence might say we should be near something of a top where we sit today. So look, guys, thanks for taking time out of your day to watch this. Thank you for your subscription. If you're not a subscriber, I want to thank you for considering it. Go to sp500chart.com, see what you get, see what it costs. I'll give you a hint. It's pretty cheap. So guys, thanks for watching. And once again, take care.